Good afternoon, everyone. I'm really glad that you've joined this webinar. So we're running a series on social care mergers at the moment. My session is the second one in this series, and it's all around key considerations where a charity is involved, um, obviously relevant to the social care sector. So my name is Martyn Robinson. Uh, I'm a lawyer in the charities team here at Hempsons and advise charities, social enterprises, um, not-for-profit organisations of all types, really. So, um, and I've been a lawyer for just over 10 years. And recently joined Hempsons, where obviously health and social care is a huge part of what they do. So it's a lovely coming together for me of a number of interests. Just to give you an overview of the webinar series, some of you, it sounds like, joined last week for the introduction to buying and selling, which was run by property and corporate colleagues. Recordings of that webinar are available. So if you didn't make that one and you're interested, do get in touch with us and ask Heather in particular, and we can get you a recording of that one. So I'm building on that today, hopefully not repeating too much or duplicating what was said there last week, and focusing, as I say, on charitable providers. So I'm going to talk about three main scenarios. The first one is a charity to charity merger. So that's numbered 1 here on the slide. The slide actually expands on that, so I'll talk about that in a moment. But just to give you a sort of broader overview. So we've got the charity to charity merger. We've also got a business that buys the assets of a charity. I'll talk about that in the second section. And then the third section is around a charity that buys a business. So I'll be going over these three sort of different arrangements and talking about the particular kind of key considerations arising. I think the first section around charity to charity mergers probably has got a little bit more technicality in it, so I'm going to start with that one. So charity to charity merger, I've outlined on this slide 3 different kind of primary ways in which charities merge. So there are three main types in effect. So the first one is fairly straightforward, where a charity, so charity A, transfers its assets and liabilities to charity B. Now, in that scenario, there's usually a dominant party, essentially. So A transfers into B, and A, in most cases, will dissolve or will become inactive, and often an inactive shell charity. But more commonly, they will dissolve. So you've got a kind of dominant party, charity B, which then goes forward. The second type is where you have 2 charities, so charity A and B, and they create a new charity, charity C, and they both transfer into that new one. In that instance, you often end up with a new identity, perhaps a new name for this merged charity. And then the third type is where a charity, so charity A, takes over legal control of another charity, creating a group structure. So what you end up with is a charity with a subsidiary charity. B is not dissolved, B remains as it was. And I think in the case of this third type, a key characteristic is that the management is often preserved. So those management positions can stay in place. There's still a CEO, there's still perhaps self-contained finance functions and back office functions and things like that at the start anyway. It can often lead to a subsequent merger, though. So I'd say that third type, where you end up with a group structure, can result in an eventual hiving up where B is transferred up to the parent. But and that can be appealing in some cases. So a two-stage merger, which allows a sort of bedding in period. Um, Now, if people are comfortable doing it, it would be really helpful and interesting, I think, if anyone has experience of having been through a merger of these types, or if you say you are actively considering a merger of this type, uh, feel free to drop that in the chat, and that would be useful, I think, if we're sort of discussing issues and picking up questions later. But yeah, I've outlined three types there. It's possible as well that you've perhaps been involved in more novel or different arrangements. Every merger is different, but yeah, I've outlined the three main types there. So if you have got experience of those, do feel free to put a note in the chat, and that'd be useful to know going forward. Um, so we've got these three different types. The key considerations, if, for the most part, still remain the same, regardless of the merger type. So I've got a number of bullet points here that I'm going to speak around. And some of them will have come up in the first session on social care transactions, but I'm going to talk about them obviously with this particular kind of charity hat on. So, in the charity to charity merger, like any merger, due diligence is almost like the jumping off point, and is a key a key step at the outset of any merger. I mean, in particular for charity trustees. Their legal duties require them to act in the best interests of their charity. There's a whole load of Charity Commission guidance on decision making and serious decisions, which emphasises acting with reasonable care and skill. There's a whole load of legal duties that require trustees of a charity to not take any light decisions around merging. But then again, we sort of have to think as well about why organizations merge. Sometimes a merger is becoming almost a necessity because of financial pressure. So there can be mergers of that type where there's a pressing need almost to find a solution for an organization, which again points towards this idea that often in a merger you have a dominant party. But also charities, and we'll talk about this at the end of the session, but and for all organizations really, it can be a useful step to have a merger strategy. So to sort of already have in mind that, well, if the right opportunity comes along, this would be in the best interests of our charity, whether it's sort of extending into a particular area, you're extending your geographical reach, or providing more support to your existing beneficiaries through sort of supplementing and adding to your organization. So due diligence is all about making sure you know what you're getting yourself into as a charity as far as possible, and bottoming out all aspects, so legal, financial, and otherwise. And often charities will put together working parties and shadow management groups and the like in that stage. That's not drastically different to most mergers. So one thing that is different when you talk about charity, and particularly with a charity to charity merger, is that there's a requirement that the charities have compatible charitable objects. So for um, charities coming together, there can't be a mismatch or misalignment of their charitable purposes. And it's becoming an area of, I think, increased scrutiny and increased focus. So broadly, if a charity, for instance, you could have a slight mismatch in terms of how they were founded, what they exist to do, um, as written in their objects, say in their governing document, but um, on the face of it, these charities seem like they do similar things. But then when you get down to the wording of their charitable purposes in their governing document, there could be geographical restrictions, there could be restrictions on the type of beneficiary they exist, to support. There might be restrictions on what they can do. And if there's a mismatch or a misalignment, then that needs dealing with as a matter of kind of preliminary due diligence, and sometimes action is actually needed to ensure alignment of objects. That can mean that the transferring charity actually needs to amend its purposes so that they match those of the transferee, so the recipient of assets. That's almost the best outcome, because what you don't want is a merged charity where assets have been transferred subject to a restriction, which is what happens when you have this sort of misalignment of objects. So essentially, the trustees, when they sign off on a merger, if there's no compatibility there, they essentially are required to bind the assets that they're transferring for the charitable purposes of the transferring organisation, which creates a restricted fund essentially, and a restriction on received assets, which creates a sort of practical headache for the merged charity going forwards, and can be tougher to untangle, to be frank, post merger. So in the pre-merger preparation, a focus on that point, looking at compatibility, is key. And if you can, making sure that the objects of the two charities align can kind of solve and smooth over a lot of subsequent issues. It means that the merged charity is almost like one organisation, one pot of money, under a harmonised set of objects going forward. The next point there is around key contracts and key assets. So as part of any merger, and this isn't exclusive to the charity sector, any key contracts with commissioners would need checking for non-assignment provisions, any other kind of restrictions. Also, because charities often have grant funding or other kind of donations or other sources, those grant agreements, the terms of those need checking. Sometimes grant agreements can be trickier to sort of novate than contracts where relating to service provision. So there's a whole piece there around, again, it's part of due diligence, but checking those key contracts, those income generating arrangements. When it comes to assets, charities and their assets can be slightly thorny and tricky in how they're held, particularly those older charities, those charities with a kind of a foothold in the past, charities that have had donated land that might have been founded on the basis of donated land or legacies of monetary legacies or the like. So part of the due diligence process would be around assessing the key assets of the transferring charity, in particular to check if any of the assets are subject to what's called a permanent endowment restriction, which is where the assets essentially have a restriction on sale. So if you come across a permanent endowment asset in a merger scenario, some specialist kind of legal input is needed at that point to make sure that the charity, the transferring charity, has the power to actually do that, and in some cases it can require an application to release permanent endowment restrictions. And you also get charities that hold what's called designated land, which is land that is subject to a kind of softer restriction, but it's held for particular purposes of the charity that are express and written into the the governance of the charity. So again, where land has been gifted or donated at some point in the past, there are particular requirements in law around selling or transferring designated land. It usually just involves a public notice requirement, a sort of consultation step. But charities, as you'll know, subject to these sort of odd layers of regulation and legal restrictions, these points need covering off, identifying early in the process, and then those points can just be accommodated. I've listed here as well third-party consents. That could include the kind of standard set of, landlord, lender, key commissioners and other contracting parties or grant funders. One point in particular that we would always be monitoring is whether consent is required from any regulators. Obviously, charities can sit across a whole host of fields in terms of the sort of regulatory context. So checking and creating a timeline essentially that ensures that any consents are in place is a key consideration. Charity commission consent, it's fairly rare that it would be required in a sort of straightforward merger scenario. Generally, charities have express and clear powers to merge, and if they have the power to do that, you sort of start to question why the Charity Commission should be involved. There are ways in which it can catch, and that regulatory consent can be needed there from the Charity Commission, but for the most part, they wouldn't expect to be sort of brought into a charity to charity merger. That there wouldn't be any sort of need for their intervention there. Governance arrangements listed there on this slide is around, well, how is the merged charity, going to be governed going forward? Now, I outlined 3 different types of mergers on the previous slide. So in the first one, the kind of A to B straight charity merger, where one of them is going to be dissolved, you obviously have the issue of the merging of posts. So perhaps there's going to be one chief executive, there's going to be one finance director going forward, and so forth, which can create difficult conversations. Sometimes there are fortuitous circumstances, people approaching retirement or looking for a new opportunity, but that isn't always the case. In the main scenario, as I mentioned earlier, is where perhaps you create a group structure, you then preserve the management functions of the merging charity because it remains a discrete and distinct legal entity. So you have more of a sort of slightly trickier discussions and headaches if you're in a kind of merger that doesn't involve that group structure. But that does need tackling, and it's not just staff; it's also the board. The trustees. If you're bringing together two boards, in most cases you require resignations, and that needs addressing early on. Sometimes trustees are carried over. Sometimes trustees expect to be stepping into senior roles in the merged charity there, on the board, which can introduce a sort of a conflict element for trustees if they are starting to think about, well, I'm jumping into a new context and starting to think about, well, are they truly acting in the best interests of their charity if they're thinking about their role in the new charity. So there are some governance kind of there's a governance piece there to think about and untangle. The charity name, often on the occasion of a merger, you have created something new, and the charity may need a new name. It may maybe just be desirable. That can be a point of negotiation as well. It might even be written into any documentation that this is a condition of merger, that the charity adopts a new name, brand, and identity. All of that can be covered off, fairly easily, but it needs discussing and agreeing as part of the process. Documenting the agreement is often where our firm would be involved. We sometimes have very discreet involvement in merger scenarios, and it will be around usually drafting a transfer agreement of some kind, sometimes using a vesting declaration. It depends on the scale of the transaction, but there may be property that's transferring. There may be major contracts that are being novated. So documenting the agreement is often, where legal support is valuable. In addition to those kind of key points I mentioned on the last slide around legal due diligence and compatibility of objects. Within that transfer agreement, within the arrangements there that are signed up by the charities, there is usually a slice of liabilities that are excluded from the transfer, which I thought I would just mention. I mean, generally, when a charity merges, all assets go across and all liabilities go across. There'll be no cash left in the transferring charity to meet those any liabilities that arise. But the thin category that are excluded are essentially those that relate to the most serious sort of level of misconduct or fraud or equivalent behaviours, where liability would attach personally to anyone involved in that activity anyway. But that is usually provided for. So a charity entering into a merger and acquiring assets and liabilities has the comfort, at least, that if a board or a trustee in the past has acted in a way that was a serious breach of trust, that they won't be meeting the cost of that, or the liabilities attached to that conduct. And finally, I mentioned the Register of Mergers, which is something operated by the Charity Commission, where this has happened, a sort of A to B standard merger. As I mentioned, charity A that's transferred its assets will usually dissolve, and if it does, then you can register that merger. And the benefits of that is that it's on the public record as having occurred, and there are mechanisms in the Charities Act which allow for any legacies, donations that might sort of crop up or pop up over the years to seamlessly transfer into the merged organisation. So that the final step in any kind of merger is often to register it with the Charity Commission to kind of make good that mechanism in law. So that's charity to charity mergers, and some of the key considerations from a legal point of view, legal and regulatory point of view. I'm just going to move on to the second type of transaction, which I mentioned at the start, and I'm going to touch on here, which is a business buying the assets of a charity. And hopefully, as I move through these topics, because I'm conscious that there may be non-charities on the call, there may be businesses on the call. Hopefully, we'll touch on and come at this from an angle that's relevant to your organisation. So we land here on a business buying the assets of a charity. This does happen. Now, generally, when a business buys a charity or buys the assets of a charity, we are talking about an asset transfer. Most charities, most of our sort of substantial clients are constituted as companies limited by guarantee. They have a whole load of restrictions in their governing document. They have charitable objects. They have um, restrictions on what they can do with their income and assets and so forth. Charities don't fit very neatly in the kind of group structure of a business. So what we generally see is a business identifies a charity, likes the assets of a charity, it aligns with what they want to do, and the charity makes those assets available for sale. And sometimes it's the entire undertaking and assets of a charity. And a business is obviously not an obvious partner necessarily for a charity. So let's talk a bit about how this might come about and how it might work. Now, if a business wants to acquire the assets of a charity, the kind of key initial question is around determining value. The charity and the board of that charity will almost certainly, in the exploratory stage of trying to sort of solve their issues, or driven however they're driven, will almost certainly look at merging with another charity. So a charity in distress or a charity running out of steam will almost certainly look to that first type of option, merging with another charity, because you have that alignment of mission. You have it's almost simpler from a kind of charity, from a legal and regulatory point of view, for charities to come together, and it's such a well-worn path. Charities merge all the time. It's less common for a business to intervene and to make the case that, well, your better option here is to sell. Now, well, why would a charity do that? Well, first of all, it's a transformative act for a charity to sell its assets. So, first of all, the charity would need to, and the business would need to determine, what's the value of the assets on offer here. It may involve buildings, contracts with commissioners and so forth, the staff, its operations, goodwill. There may be some cash, but this is all held within a charity, which and all those assets are held for charitable purposes and need to be applied towards that charitable purpose. So the question is, well, how do you liberate that from a charity? Well, if you put a value on it, and there is there's a market value for any asset, then it can technically be purchased. So and that means that the charity, if it sells all of its assets, for instance, at market value, it will then become a charity of funds, because it will get the proceeds of sale. So the big second question is, well, what will the charity be post sale? So if a value, let's talk roughly, if a value of £1 million is determined between the parties, and the charity sells all its assets to the business, then it receives £1 million. It's suddenly a trust or a charity of funds, and it needs to have a new set of objects and a new mission. So this is a completely kind of radical and transformative act for a charity to go through, and it's quite, I would say, I suppose, from my experience, quite rare, but it does happen, and we have seen it, and my supervisor and I have been involved in projects where this has occurred, and I must say they can involve a long kind of period of head scratching and thinking, and due diligence around, well, do the trustees of the charity even have the power to do this? And what's the charity? Yeah, as I said, what's the charity going to be after selling all its assets? And how do you value those assets? Well, there are professionals who can do that. So you can get people to value the assets of a charity. Sometimes a charity in distress has debts or liabilities that reduce the value of what they have there and what they're operating, which can become a kind of point of negotiation. But again, then that brings a big focus on, well, uh, we're in trouble. We have assets, but we have debt as well, and the value, you may get a business trying to kind of make the case that there's not much there in terms of value, and that this is a sort of a savior, a white knight type, um, uh, you know, action. And the big question then becomes, well, do the trustees have the power to do that? Can they agree to this? If it feels like a sale, and it's going to create a charity, a charitable fund, but it's not going to be a huge amount of money. Well, it needs careful consideration in the moment. But broadly, charities have powers um, to sell their assets. So when you take a step back and look at it, it can become quite a sort of straightforward, answer. Um, in all likelihood, the trustees are able to do this. It just feels novel and strange for charities to shift those assets from the charitable sector into the commercial sector, and to completely change the character of what they do. So a charity post sale will have a pot of money, and then you don't necessarily need a board of 12 trustees with all sorts of expertise and all the rest of it. It might become a grant giving organization, but it will need new objects. It will need a new name. It will probably need a smaller board. And agreeing that transition, and all the assets, from that used to be used for social good and towards their charitable purpose, will sit in a business, and will be driven, towards the interests of that business. So determining the value is kind of crucial, because what results is a charity with a pot of money. It's quite unusual, as I mentioned, but it's out there, and it does happen, and we have seen it, and we have advised on it. Now, just a few more points to mention around this. Reputational issues become a kind of key consideration, because charity and charity trustees need to have regard to their reputation. Is this in the best interest of the charity is kind of the key driving principle for any charity board. So any conflicts have to be managed very carefully in a sale. And they have to amend their objects almost certainly, because going from a landowning, service providing, large operational organization to a sort of a charity with just a fund is a complete shift. So new charitable objects are almost always needed. Now, you would think charity commission consent or involvement has got to be necessary if a charity wants to sell its assets into the commercial sector, but it's not strictly or necessarily the case. It will always be on a case by case basis. It will come down to whether the express powers in the governing document of the charity. It will also depend on whether there are conflicted people or individuals there, and whether those have been effectively managed or not, and the level of consensus within the charity, or certainty in the charity around their powers. But I personally have been involved in a matter where an uncertain board of trustees wrote to the Charity Commission for advice on this point, and the regulator was not sort of quick to jump in and want to get involved. They really just pointed it, threw it back at the charity, saying, "Well, do you think you got the power to do it? You've got the power to sell land, to sell your assets, to enter into contracts and the like." And it kind of doesn't always again spark the interest of the regulator. They obviously want charities and trustees to discharge their legal duties, and to comply with the law. But selling their assets isn't necessarily something that requires regulatory input, again, which is perhaps surprising. You would think that the regulator would need to green light something like that, assets leaving the sector. But if they're paid for at market value and money has been exchanged and is, and then held for charitable purposes, then it's not drastically different to, to selling any other asset, I think, from the regulator's point of view. So we come to the third type, and I think this is something we see from time to time, which is where a charity decides to buy a business. So we're looking at it from the other way around now. Well, it doesn't necessarily have to be an asset purchase in this situation. It could be a share purchase, because a charity can obviously have a subsidiary. Many charities have subsidiary companies for trading purposes. So there's a little bit more flexibility there in terms of the mechanism and the way in which a business lands with a charity. If a charity's in the market for this, they're obviously potentially bidding alongside other commercial operators. So a big question would be around the motives and of the seller and the owner of that business. What do they see for the future of their organization, and are they just trying to try and sell at the highest price, or are they perhaps interested in legacy and things like that? So charities can make the case, but they are usually going to have to pay. So desirability of buying a business is there's a big question mark there, as against option one from this presentation, where a charity just merges with another charity for nil consideration. Why would a charity use its money to buy a business when there are many charities out there looking for a merger partner, looking to collaborate? No money needs to change hands. So charities buying a business is, we see it, but we see it in kind of perhaps more sort of discrete cases. I've seen, for instance, educational charities buying training businesses, or looking for assets, or an extension into an area, or perhaps something that they think is going to make money. So there can be reasons that charities want to do this, but they're going to have to pay a price in order to acquire a business in almost every case. So again, it comes down to determining value. How much is a charity going to pay for business or its assets, and how much can it pay? Why buy? As I say, because you've always got option one there, and can look for charities that can merge on a sort of more of an equal footing without an interested seller. So that aside, if we assume that a charity wants to buy a business, believes it's in the best interests of the charity, they have the funds to do it, they make the case, they have the rationale all lined up. A key consideration is then going to be around, well, is this a trading business, and does that trade fall within the objects of the charity? Because charities are only able to trade in furtherance of their objects. I might just skip to the next slide to discuss this point. So when it comes to the question of trading, charities can trade. They obviously do trade. Charities in the health, and social care realm provide services. Those services are often paid for, and a trade has taken place. So trading in furtherance of your objects is perfectly acceptable. Now, some trading carried out by charities is deemed to be what's called non-primary purpose. So that's trading that doesn't further the objects of the charity. It just generates money. So it's a kind of money-making, fundraising form of trading, often called just commercial trading. So when a charity buys a business, rather than, say, merging with another charity, some care is needed to analyze what the operations are within that business, what trades are taking place, and whether those activities further the objects of the charity and therefore can be undertaken by the charity itself, or are non-primary purpose or commercial trading. Because if it falls into that latter category, the charity probably shouldn't be doing it, or running that activity itself. It wouldn't be benefit from tax reliefs, which so most charities channel their commercial trading through subsidiary companies anyway. So there can be a sort of analysis needed there around, well, what's the company doing? There may be certain activities that the charity wants to take on itself. And a charity buying a business, I mean, it can really take on so many different forms. A charity could pay for the shares in a company, acquire a subsidiary company. There could be a subsequent hive up of certain assets or activities to the charity. Some may be left in the subsidiary, or the whole thing could be just left intact and deemed to be a kind of either an investment that's going to hopefully make money for the charity, and each year profits will again be hived up, or a social investment that kind of furthers the objects of the charity but also makes a bit of money. So some purchases might fall in that kind of middle category of a social investment. But again, when a charity has to sort of compete to buy a business, have the funds or the finance to buy a business, and may even be in competition with other buyers, it becomes a sort of slightly shrinking pool of in terms of frequency in the market. I think it's really where a charity sees real value, whether in terms of future income, or it's a strategic move, or it's a particular asset in that locality, or extends their activities in a particular way that makes it a desirable step, and therefore in the best interest of the charity. But it's not something to be done lightly within that kind of charity, through that charity lens. Having said that, in recent months, colleagues of mine in the corporate team have done exactly this transaction. So charity bought a business, bought the shares, the sellers were paid for that, for transferring their shares, and a range of other kind of subsidiary companies. And that becomes a kind of classic corporate transaction, really, with there can be there are warranties, there can be deferred consideration and everything else. One key difference is that where a charity buys the shares of a company, it in some cases it doesn't need to pay stamp duty on the share purchase, because there are reliefs in tax reliefs for charities. So a small windfall there for a charity buying a business is, well, hopefully there may be a tax relief in terms of that share purchase and the stamp duty arising. So the last slide, in terms of key considerations on this topic, I just wanted to talk about developing a merger strategy again. Now, it doesn't necessarily involve a lot of law, but from a governance perspective, it's certainly something that boards in the social care field would be wise to consider. I've outlined 3 scenarios here. We can sort of get more granular and do categories of merger and everything else, but talking about these types of transactions and the options in your region, or just generally for your organization, is certainly a worthwhile thing to do. And as soon as you start looking at the options and start talking about them, you're almost like incidentally developing a merger strategy. So who are the desirable partners? which organisations are doing it well. That we'd like to be doing it like this. We'd like to expand into these areas. These are the kind of properties we'd like to be acquiring or working in, or these areas, or these types of beneficiaries of these services, and so on. So developing a merger strategy, and within that, you then start to lay the groundwork for when conversations occur and when options become available. That you've almost signed off on a certain sort of type of transaction, and if one becomes available, then you can skip a step because you've already kind of prepared and agreed in principle that you would be interested in starting that discussion. So it's something that boards should definitely think about. Now, mergers are not particularly straightforward. I mean, a lawyer may not always be involved as well on the sort of the difficulties and the complexities of managing a merger from the inside, but we're well aware of the difficulties that can arise. I mean, it can be very difficult just to get the boards to a position of agreement, and those senior staff members as well who are looking at perhaps competing for job posts and the like. It's not specific to the charity sector there, but dealing with disagreement and kind of staying on the path is that pressure can fall very heavily sometimes on one or two individuals as well. You might be the chief executive who thinks it's a good idea, but and it can become a lonely place if you're dealing with disagreement. And so it's worth just mentioning, because mergers involve a lot of time, they involve a lot of cost, and they involve a lot of effort and energy. But then again, I'm aware of organisations who've merged and merged again, 5 mergers in a decade, and they just keep going. So they are achievable, and they're in some cases highly necessary for the survival and success of an organisation. And then there's a line there on recording decisions, just around, especially when charities are involved, those board meetings, getting good minutes, recording disagreement, making sure that people's views are heard. But the way that, if you're a charity, the way that you operate is, majority decision and the majority rules, and then everyone has to get behind that. So, but recording decisions and making sure people feel like they're heard is a key part of that. And so we're often involved in drafting papers, drafting board papers, minutes, and things like that explain the rationale. So I just mention it as a sort of a key governance point. I'm going to have a quick look at the questions. Or Heather, I don't know if you've had a chance to have a look and see if anyone has submitted anything. Obviously, if you haven't, but you have a thought after the session, feel free to send an email. My details are on the slides and will be there at the end. So you can get in touch.
Yes, we have had one question. Are charities impacted by Competition and Markets Authority, and what percentage of a market would trigger a concern?
Yeah, it's a good question. I think in my experience, this has not been a consideration. I'm not a competition lawyer, and I'm generally coming at it from a charity law and regulation point of view. So what I don't want to say is anything definitive on this session, which is then easily contradicted. But I'm happy to follow up with the when the slides go out with a bit of extra commentary on that point. Basically, in my experience, that has not been relevant on transactions that I've advised on personally. But what I'll do is I'll field comments from the rest of the team, and I can feed back on that when we send the slides out, because yeah, I mean, it's obviously a consideration when you get to a certain scale and level. It won't be relevant to everyone on this call, but I'm happy to feed back on that. My contact details are there on the last slide. Feel free to ping me an email, or if you have any questions, or as I say, you can call the social care advice line. Even better, you can get on the phone with us and ask any questions, including relating to the content on this session, or just otherwise in terms of your organisation. But yeah, thank you for joining today. I hope it's been helpful, and we hope to see you again on. Well, there's a third session, which is going to be run by my employment colleagues, which will be, I think, a big help. But yeah, we run all sorts of webinars and things throughout the year, so hopefully we'll see you on one soon.